Okay, hello. This is my 10th lecture in a series on the South China Sea. And today we're going to focus on oil and gas resources in the South China Sea. All right, so estimated oil reserves is 11 billion barrels total in the South China Sea. First of all, China's not trying to steal all of South China Sea oil. I estimated 70%, and I believe this estimate is generous, right? So if you assume this is 20%, right? Well, here's all the South China Sea oil, okay? And uh, I mean, if you make a guess and say this is 20%, and then if China, so this is Chinese oil as it is. It's in China's economic exclusive zone. Same with this. All right. So if they steal 70%, well, they got 90% of all South China Sea oil, which means, in my estimate, that leaves only 10% for others. I'm leaving only 10% for all the other nations. Now, if you look at this, right, this is a rough drawing of China's a nine dash line, right? So this belongs to other nations. This is Vietnam, all right, and maybe this could be like Indonesia, Malaysia, Brunei, Malaysia, Philippines. All right, all this stuff here. I mean, that's got to be more than 10%. All right, I'm thinking it's more like 25, maybe even 30%. Right, it's just a guess. So for me to say China's stealing 70% is generous, right? Which means they're trying to take 90% of all South China Sea oil. All right, so I think that's very generous and fair. How much will theft help China's annual oil consumption? Assuming they have 70% theft. China consumes 14.22 million barrels per day. That's 5.19 billion barrels a year. All right. So then you take 11 billion barrels times the 70% theft, right? Times their oil consumption rate, right? That gives you only 1.48 years. So all the stolen oil is less than a year and a half of oil for China. Big deal, right? But how much is that going to benefit them? Plus, you're not going to get that all in 1 year or right away. I mean, it's going to be spread out over how many years it takes you to pump it dry. All right. So, how much will theft help China's GDP? All right. 2019, the GDP was 14.34 trillion. So, to do this analysis, I have three assumptions, which I've explained before. I'll explain it again because it'll probably be attacked. 20% profit margin. Right, I think that's fair. China steals 70%. That's fair. And 20 years to pump out all the oil so it's bone dry. You pump it up. Yeah, I definitely think that's fair. I mean, I'm thinking good luck trying to pump it all out in 100 years. All right. Also keep in mind that this means you got to take annual measurements. GDP is an annual measurement. Your analysis must be on an annual basis. All right. All right. So 11 billion barrels of oil times 70 dollars per barrel times 2% profit margin times zero point 0.7 is what they steal. Divided by 20-year extraction rate is $5.39 billion per year, right? So to get percentage of GDP, you got to take $5.39 billion divided by 14.34 $14,340 billion for the GDP, times 100, and then you get 0.0377%, right? All right, of the annual GDP each year for only 20 years. right? Which means after 20 years, you're done. You're not going to get this benefit anymore. You're out of oil. All right? Was it worth all the fight? I believe my above estimates are generous, but many will falsely accuse that I cheat the numbers. Bullshit. So you got to take profits. All right? You know, I'm not going to take the bullshit. Oh, he's cheating on profits. Profits must be examined because stolen oil in the ground must be extracted, which requires costly operations, building ocean oil rigs, which I can't imagine is cheap, drilling into ocean floors, sometimes deep, right? You know, deep water things are over 1,000 feet. Pumping up that oil, which can be energy intensive, depending upon the pressure the oil is under naturally, right? I think the method is you pump down water at high pressure and you squeeze up that oil. Labor cost, accident cost, wear and tear, maintenance and repair, blah blah, insurance costs, all the other overhead. It adds up. So I'm saying 80% operating costs, 20% profit is pretty generous, right? I looked at a few companies. I mean, I didn't do like this massive search, but I looked at some major companies that came to mind. I looked at Tesla. Hey, what's Tesla's profit margin in 2020? 2.7%. Right? What was General Motors? 5%. What was Ford? They had a loss, I believe. I believe it was Ford. Ford had a loss in 2020. Negative. So 20% is generous. China cannot steal all the oil. 70% theft is a fair estimate. I explained it above here. 70% is fair. Any cost-benefit comparison must use annual data for 3 reasons. 1, while oil and gas are fixed quantities that are depleted and then done, that's not true for fish. Fish reproduce and are thus renewable, right? Every damn year you're going to get more fish, right? On and on and on. So you got to do an annual basis analysis. It's not going to be depleted at a certain point. Therefore, a comparison of all 3 profits must be annual. If you're going to compare with one that is annual, you got to make the others annual. Sanctions are not a one-time cost, all right? And will take a percentage out of the economy every damn year indefinitely until you stop the sanctions. And therefore must be accounted annually. China will not be able to build all the oil rigs and then pump the South China Sea completely dry of oil in 1 year. Therefore, accrued benefits from the oil must be spread over many years, just as the cost of sanctions are incurred every damn year. Therefore, you must examine costs and benefits on an annual basis. My analysis is not cheating. It's just being realistic. Right? It's for people who have a clue. And like I said, this is simple analysis. A 4th grader should be able to think this up. Benefit cost analysis. So the benefits we said is 0.0377% of GDP. That's a joke compared to the potential high cost. What are those costs? 1, U.S. and EU sanctions. Cost of war. Boycotts and embargoes. Diplomatic isolation. Lost business opportunities for Chinese companies. So one of these costs alone. So we just look at U.S. sanctions, nothing else, right? Just look at it, right? That far outweighs the benefits by itself. Only one cost. All right. So stiff U.S. sanctions could cost, China's economy 1 to 3% of GDP, right, annually, depending how stiff the sanctions are. While the benefits from stolen oil is a mere 0.0377%. This means this one single cost by itself is 80 times greater than the benefits. Oh, we're going to steal some oil. Oh, but you get whacked 80 times more. It costs you 80 times more. Well, smart. Then when you add in the other costs, it's clearly not worth it. All right, these add up. Given the unfavorable cost-benefit analysis, a better play for China would be, one, continue to purchase oil in the open market while accelerating their shift to electric transportation. And China's leading the world in this. Who's got greater electric public transportation than China? They got the greatest fleet of electric buses. Why is that a benefit? Well, electric transportation per mile cost is between 2 to 5 times cheaper. I think trucks are around 2 times cheaper, but smaller vehicles are up to 5 times cheaper per mile. So if you're paying $1,000 in gas a year, well, you can be cut to $200 a year with electric. And as technology advances, electric vehicles are going to get only more efficient. 2, offer investment capital to partner in joint oil ventures with other South China Sea nations. Instead of trying to steal their damn oil, well, why don't you invest in their companies? Right? You're going to make a profit that way anyways. Offer capital. Offer investment capital to boost productivity. For example, infrastructure and education, which is what China's doing in its Belt and Road thing. In African oil-producing nations, as part of their Belt and Road initiative to negotiate favorable trade deals, including favorable oil prices, right, and to increase the disposable income of the local country to make them bigger customers. And you're making trade deals with them, right? Right? Make them more productive. They have more money to buy your crap. You can sell them more crap. Partner with Canada, Greenland, or Russia to develop emerging global warming Arctic, I say emerging / global warming, Arctic ocean possibilities. I say that because, offshore oil rigs, gas rigs, all right, you can't build them where there's ice flow. Flowing ice will just cut them apart. It's like a glacier. It's going to tear through them, right? So it's only possible if you have recession of ice during winter, all right, and that's happening more and more pretty rapidly in the Arctic Ocean. The ice pack is shrinking rapidly, right? And hydrocarbon estimates in the Arctic Ocean dwarf South China Sea. So instead of 11, you got 90 billion barrels of oil. Instead of 190, you got 1,669 trillion cubic feet of natural gas, right? Both of which are almost 10 times more. Why make a big deal about South China Sea? You got far better opportunities, right? More and more as we heat up this world, is going to expose that. So I say sea map here. Who's got access to that? It's Russia and Canada. Over here you got Greenland a little bit. Greenland is not as much, right? But it's mostly Russia and Canada. Oh, this is Canadian shoreline here. All right, this is Russian. Partner with them. The point is, China has better investment opportunities than the South China Sea theft. Finally, I have no idea why Americans are all hot and bothered about South China Sea oil, because USA has zero claim over it. U.S. companies, and it's not going to be USA, it's going to be U.S. companies. Why do you give a damn about these companies? Unless you're invested in them. U.S. companies could only negotiate deals with South China Sea nations, including China. China made this deal with Crestone, a Denver-based company, back in '92. Um, or stake claims in the high seas center portion of the South China Sea. But most of that is deep water, up to 18,000 feet deep. And the deepest oil platform in the world is Perdido. It's in the Gulf of Mexico at 8,040 feet deep. So I'm thinking this is, you know, too deep to feasibly pump out oil from them. So this is that center portion, the high seas portion. This is like Vietnam's exclusive economic zone. Here's China's. Here's Philippines. That's Malaysia, Brunei, Malaysia again, right? All this stuff in the middle here, right? That's high seas. That's no one's. That's up for grabs for anyone, you know, who can build a oil rig there. All right, bottom line. I believe China will try to get whatever it can on the cheap, but won't risk a big confrontation in which they sink ships and kill a lot of people because the cost-benefit analysis is so damn poor, right? They're just going to lose more. The total value of oil is so low that it's not worth the fight. Why are they making such a big deal about the South China Sea? For what? Plus, I mean, it's all hype. Plus, China has alternative options. Therefore, any attempted Chinese theft must be resisted. They're going to try to get stuff on the cheap, but you resist them to force China's hand because it will just go bad for them, right? They're just going to lose more. Most of all, China must be made to follow the law because that is the best for everyone, including China. Without the law, there is chaos and anarchy, conflict and war. All right, so now we'll look at gas real quick. And gas is simple because it's basically the same analysis, right? Everything that applies here applies to gas. Just the numbers are a little bit different. So 2020, the average annual price for gas, the spot price was $2.03 per cubic per thousand cubic foot, right? So if you take 190 total cubic feet, all right, and you convert that to percentage of annual GDP, it comes out to 0.0188% of their GDP. Wow, big deal. The same cost for stealing oil applies to gas. For example, U.S. sanctions, 1 to 3% of GDP. So if you compare that to 0.0188, that's 160 to 1 ratio. For every dollar benefit, well, you lose 160. That's a good deal. Let's do that. And then you got to add in all the other costs. This is only U.S. sanctions. So, also, China has massive 1,115 trillion cubic feet of shale natural gas. Right? Shale is tight, right, between the rocks, you know, sedimentary rocks. So to get that, you got to frack it, right? But they can frack it, right? I mean, I'm not sure where it's located, how deep, and what are the costs for extracting it. I don't know, right? But that's an option. They're pressed for gas. They got gas themselves. Finally, the price of electricity from wind and solar are twice as cheap, more than twice as cheap as the most efficient natural gas burning system, which is the combined gas and steam turbine system, right? And their prices continue to fall with advancing technology. Who's got potential to advance technology? Burning gas, burning coal? Hell no. The open frontiers for technology improvement is in wind and solar, right? So renewable is your best investment opportunity. All right. All right. So that's, you know, oil and gas is just not worth it. Okay. It's not worth the fight. I mean, they're going to try to get stuff on it cheap. But, all right.